Have you ever felt like you're working harder but falling further behind? You get a raise at work, but your grocery bill and your rent seem to eat it up before you even notice the difference. It's one of the most frustrating feelings in our modern economy. Let's look at the simple data. Back in the year 2000, a typical fast food burger might have cost you around $2. Today, in 2024, that very same burger is likely closer to $6. It's not just food. In 2000, a movie ticket was about $5. Now, you're likely paying well over $10, maybe even $15, for the exact same seat in the same theater. So what is happening? Why do prices relentlessly march upward? Is it just corporate greed? Are sellers coordinating to raise prices on purpose? While those can be factors, the real answer is a single, powerful, and often misunderstood economic force: inflation. You hear this keyword on the news every single day, but it's often discussed as just another abstract number. The inflation rate is up, the inflation rate is down. But what it really means is that your money is losing its value. Inflation is the silent, invisible tax on your savings. It's the steady decay of your purchasing power over time. Let's think about that. When inflation happens, it's not just that the burger is becoming more valuable. It's that the dollar in your pocket is becoming less valuable. Your money simply cannot buy as much as it used to. Think back to the 1970s. The average price of a cup of coffee was only around 25 cents. Today, in 2024, if you tried to buy a cup of coffee with that same 25 cents, you would be laughed out of the shop. The coffee didn't fundamentally change, but the value of that quarter evaporated. This is the core of the problem. So why does this happen? Why can't prices just stay the same? Inflation isn't a single event. It's the result of several powerful forces pushing and pulling on the economy. Let's break down the main culprits. The first and most common is called demand-pull inflation. This is the classic textbook definition: too much money chasing too few goods. It happens when everyone, meaning consumers, businesses, and the government, wants to buy more stuff than the economy can actually produce. Imagine people in an economy typically want to buy 10 tons of corn, and the farmers in that economy produce exactly 10 tons of corn. Prices are stable. But let's say a massive storm, a natural disaster, destroys half of the corn crop. Suddenly there are only 5 tons of corn available. The demand hasn't changed. 10 tons of demand are now chasing 5 tons of supply. What happens? People start competing to buy the limited corn. Sellers see this, and they raise the price. A can of corn that used to cost $2 might now cost $3 or $4. The demand from buyers is literally pulling the price up. We saw a real-world version of this during the last few years with semiconductors and used cars. Everyone wanted new electronics and cars at the same time, but supply chains were broken. Too much demand, not enough supply, and prices exploded. The second major cause is cost-push inflation. This is the other side of the coin, where prices go up because it simply costs more to make things. This isn't about demand. This is about the supply chain itself becoming more expensive. Let's use a popcorn seller at a movie theater as an example. He sells a bag of popcorn for $3. Let's say his costs are $1 for the corn, $1 for the bag, butter, and labor, and he makes $1 in profit. But that same storm that wiped out the corn crop means his cost for raw corn doubles. It now costs him $2 just for the corn. His other costs are still $1. If he keeps selling the popcorn for $3, his profit is now zero. He can't run a business that way. So, he is forced to raise his price to $4 just to make the same $1 profit he was making before. The rising cost of his materials pushed the final price up for you, the consumer. A massive real-world example of this is the price of oil. When a geopolitical conflict flares up in the Middle East, or a cartel like OPEC decides to cut production, the price of crude oil spikes. Since oil is used to make gasoline, plastics, and to transport everything you buy, those higher costs get pushed onto every single product in the economy. That's cost-push inflation in action. The third reason is more subtle, and it's called built-in inflation. This is all about expectations, and it can create a dangerous feedback loop called a wage-price spiral. It starts when prices for things like food and gas go up. Workers like you see their cost of living increasing. Your $900 rent just went up to $1,000 a month. Your $1,000 a month salary doesn't cover your expenses anymore. So, you and your colleagues go to your boss and demand a pay raise just to keep up. Let's say the company agrees and gives everyone a raise. But where does the company get that money? The company now has higher production costs because its labor bill just went up. To maintain their own profits, they raise the price of the products they sell. So, higher prices lead to demands for higher wages, which in turn lead to even higher prices. This becomes a self-fulfilling prophecy, a cycle where everyone expects inflation, so they act in ways that create more inflation. Finally, we have the most powerful driver of all, the money supply itself. This happens when there is simply too much money pumped into the economy. This is often done by a central bank, like the Federal Reserve in the United States. Imagine a small economy with 5 people, and each person has $5. There are 5 loaves of bread available, and each costs $5. Everything is in balance. Now imagine the government or central bank decides to stimulate the economy and gives every person an extra $5. Now each person has $10, but there are still only 5 loaves of bread. Everyone has more money, so they are willing to pay more. The bakery sees this and raises the price of bread to $10. In the end, each person still only gets 1 loaf of bread, but the price has doubled. This wasn't because the bread was twice as good. It was because the value of each dollar was cut in half, simply because there were twice as many of them. This is not just a theory. We have seen catastrophic real-world examples of this. In countries like Zimbabwe or more recently, Venezuela, the governments tried to solve their economic problems by printing massive amounts of money. The result wasn't wealth. It was hyperinflation, a situation where prices rise so fast that the money in your pocket becomes worthless, literally overnight. Understanding these forces is the first step. But this raises a critical question. If inflation is happening, how do we even know how much is happening? Who decides what the official inflation rate is? So, these forces are constantly pushing prices up. This brings us to the most practical question. How do we even know how high inflation really is? You've probably heard news anchors talk about the inflation rate like it's a single solid number. Governments and central banks point to this rate constantly. If inflation gets too high, it can panic the markets and hurt the economy. But how is this critical inflation rate actually measured? How do these institutions calculate it? While there are different methods, the most common one you hear about in the United States is called the Consumer Price Index, or CPI. So what is the Consumer Price Index? Think of it as a giant, imaginary shopping cart. The government fills this cart with thousands of goods and services that the average household buys. It's a way to track how the total price of this same basket of items changes over time. Let's use a very simple example to understand the concept. Imagine in 2024, our basket only has 5 items. A loaf of bread is $3. A gallon of milk is $4. A dozen eggs are $5. A candle is $8. And 1 movie ticket is $10. The total cost to buy everything in our basket is $30. Now let's fast forward 1 year to 2025. The price of bread rises to $3.30. Milk goes up to $4.20. Eggs climb to $5.30. The candle inches up to $8.10. And the movie ticket price stays the same at $10. The new total cost for that exact same basket of goods is now $30.90. To get the inflation rate, we compare the two. The price increased by 90 cents from a $30 base. This means prices on average have increased by 3%. So the government would report that the official CPI for that year is 3%. But here is the hook. The single most important part of this entire video that you need to understand. A low CPI does not always mean your personal costs are rising slowly. The CPI you hear on the news is an illusion. Why? Let's look inside the numbers from our own example. Bread, an essential item you need to eat, went up by 10%. Milk, another essential, went up by 5%. Eggs, a staple food, went up by 6%. Meanwhile, the less essential items you could easily live without, like the candle, only increased by 1.25%. The movie ticket, a luxury, didn't go up at all. So even if the official CPI shows a small, healthy increase, you might still feel like you are being crushed. You feel this way because the items you absolutely must buy every single week, your food, your gas, your housing, are the ones that are rising in price the fastest. The CPI is just a rough, overall average that bundles everything together. It is not a specific reflection of your essential costs. This is the hidden economic shift that explains the frustration so many Americans feel. It's why you can hear a report that inflation is under control at 2 or 3%, but you feel like your financial life is getting harder. This leads to the next logical question. If inflation makes things more expensive and lowers the value of our money, shouldn't we aim for 0% inflation? Or even better, shouldn't we want negative inflation, called deflation, to make everything cheaper? This seems logical, but in the complex system of a modern economy, it's actually incredibly dangerous. Let's look at the reasons why. First, central banks, like the Federal Reserve, believe that a small, stable amount of inflation is actually good for economic growth. They usually aim for a magic number, a target of around 2% to 3% inflation per year. Why on earth would they want prices to go up? Because small, predictable inflation encourages people and businesses to spend and invest money rather than just save it. Think about it. If you know that new car or new computer will be 2% more expensive next year, you are more likely to buy it now rather than wait. When people spend, businesses grow. When businesses grow, they create jobs. When jobs are created, the whole economy stays strong and moves forward. A little inflation acts like the oil in the economic engine, keeping all the parts moving smoothly. The second reason is that the opposite, negative inflation, is an economic nightmare. If the inflation rate drops below zero, it means prices are actively going down. This is called deflation. While deflation might sound like a consumer's paradise, it is a trap. Imagine you want to buy a house or a car. If you know prices are falling, why would you buy today? You would wait, knowing it will be cheaper next month, and even cheaper the month after that. But you're not the only one. Everyone stops spending money on big-ticket items. Businesses see their sales completely collapse. To survive, they are forced to cut wages and, eventually, lay off their workers. This creates a terrifying downward spiral. Falling prices lead to lower wages and mass unemployment, which leads to even less demand and spending, which forces businesses to cut prices and wages even further. This is not a theory. This was a primary driver of the Great Depression in the United States during the 1930s. Massive deflation was behind one of the worst economic disasters in history. So, while deflation sounds good on the surface, it is a poison that can freeze an economy solid. The third reason is the other extreme, hyperinflation. If a little inflation is good and deflation is terrible, what happens when inflation gets completely out of control? The result is hyperinflation, and it is a societal catastrophe that wipes out generations of wealth. Hyperinflation is technically defined as prices increasing by more than 50% every single month. Let that sink in. Imagine in January of 2025, a loaf of bread costs $3. By February, it's $4.50. That doesn't sound too bad. But if that 50% monthly inflation continues for just 1 year, by January of 2026, that same loaf of bread would cost you $389. Your savings account would be worthless. Your pension would be worthless. One of the most famous cases happened in Venezuela, due to their government's insane money printing. The Venezuelan currency lost its value so fast that prices were increasing by the hour. Venezuelans were literally throwing their money on the street because it was worthless and couldn't buy anything. So, inflation is a terrifyingly delicate balancing act. Deflation is an economic ice age where everything freezes. Hyperinflation is an economic inferno that burns everything to the ground. And stable, low inflation is the Goldilocks zone that governments and central banks try to stay inside. This brings us to the most critical question of all. If inflation is this powerful force that must be perfectly controlled, who is actually in charge of the thermostat? And what can you do to protect your own money from being burned up or frozen? So if inflation is this delicate balancing act, who is in charge of controlling it? In the United States, there are two main institutions responsible for keeping inflation stable: the central bank and the government. They both do different things, using two different toolkits: monetary policy and fiscal policy. First, let's talk about the central bank, which in the United States is the Federal Reserve, or the Fed. Their primary tool is called monetary policy, which is just a fancy term for their decisions on interest rates and the money supply. The first and most powerful tool is adjusting interest rates. What is an interest rate? It's simply the cost of borrowing money, expressed in percentages. If you borrow $1,000 at a 10% interest rate, you have to pay back the $1,000 plus an extra $100 as interest. When inflation gets too high, the Federal Reserve will raise interest rates. This is the economic brake pedal. When rates go up, borrowing money becomes more expensive. Fewer people can afford to get mortgages to buy houses. Fewer businesses take out loans to expand. People have less money to spend, so they spend less. This reduces demand across the entire economy and helps bring inflation back down. Conversely, when inflation is too low, or the economy is in a recession, the Federal Reserve will lower interest rates. This is the economic gas pedal. Borrowing becomes cheaper, encouraging more people to borrow money and spend it. This can push prices up and increase the inflation rate, which, as we learned, is sometimes what they want. The second tool the Federal Reserve uses is controlling the money supply itself. Too much money in the economy causes high inflation, while too little money causes deflation. The Fed can control this through a method called open market operations. So, how do open market operations work? When the economy is slow and inflation is too low, the Fed wants to increase the money supply. It does this by buying assets like government bonds from large commercial banks. Think of the big banks you use, like Bank of America or JP Morgan Chase. The Fed essentially prints new money to buy these bonds, which injects that new money directly into the banks. As these banks get more money, they are more willing to lend it out, and they will lower their interest rates to compete for you as a borrower. This leads to more money in the economy, which pushes inflation up. But now, when inflation is too high, like it has been recently, the Federal Reserve does the exact opposite. This is called contractionary open market operations. The Fed will sell those government bonds back to the commercial banks. The banks must use their cash to buy these bonds, which means that money is removed from the banking system and flows back to the Federal Reserve, effectively taking it out of circulation. Banks now have less money to lend, so they will raise their interest rates. This results in fewer people borrowing money, less money in the economy, and a lower inflation rate. While the central bank handles monetary policy, the government can use fiscal policy. Fiscal policy is just the fancy term for government decisions on adjusting taxes and spending. The first tool is adjusting taxes. When people have too much money and are spending too much, driving demand-pull inflation, the government could theoretically raise taxes. This would reduce the amount of money you have for spending, which would lower demand and decrease inflation. Conversely, if the economy is too slow, the government can reduce taxes, leaving you with more money to spend, which can boost the economy. The second tool is adjusting government spending. Imagine you own a store that sells construction materials. Your business is doing well. Then, the government announces it is going to build a new bridge in your city. The government comes and buys tons of cement and bricks from your store. It also has to hire engineers to design the bridge and workers to build it. You, the engineers and the workers, all get more money from this government project. As you all have more money, you will spend more money, and this will lead to higher inflation. Now, this one bridge won't influence the whole economy. But remember, there are thousands of government projects across the country, involving thousands of businesses and hundreds of thousands of workers. These projects are worth billions of dollars. So if the government lowers its spending, it slows down this flow of money, which can have a massive impact on the money supply and help lower inflation. So now you know how the government and central bank try to control inflation. This brings us to the final, most important question. How do you protect yourself from inflation? You might have heard your parents or grandparents say, "Save your money in a piggy bank." While saving is a good habit, inflation is a force that punishes savers. Let's say you saved $1,000 in your piggy bank in the year 2014. In 2014, that $1,000 could buy a certain amount of goods. But by 2024, because of 10 years of inflation, that same $1,000 bill is not worth as much. It has lost its value. So, how do you protect your money from losing value because of inflation? The answer is simple: investing. The goal is to put your money into an asset that will grow in value faster than the rate of inflation. Many people suggest buying gold to protect against inflation. Since gold has a limited supply and high demand, its value tends to be stable or rise when the value of money is falling. People trust gold to keep their wealth stable. However, for some people, gold's price doesn't go up fast enough. They prefer higher yield investments like stocks, real estate, or other investment tools. Let's look at a clear example. Imagine in 2014, there are 3 people: Bob, Jack, and Tony. Each of them has $1,000 to save. Bob invests his $1,000 in Apple stocks. Jack invests his $1,000 in gold. Tony saves his $1,000 in a regular savings account at his bank. Now let's fast forward 10 years to 2024. Bob's Apple stock investment has grown to $9,000, an average 25% return per year. Jack's gold investment has grown to about $1,800, an average 6% return per year. Tony's savings account has grown to $1,104, from an average 1% deposit interest per year. But we forgot the most important part. We need to subtract the inflation rate from that return to know their real value. Let's say the average inflation rate was 2% per year. Bob's actual return is about 23% per year. His investment is now worth about $8,000 in 2014 money. He has profited $7,000 in real purchasing power. Jack's actual return is about 4% per year. His investment is worth around $1,500 in 2014 money. He still profits around $500. Now, look at Tony. His savings account interest rate was 1%. Inflation was 2%. His actual return is negative 1% per year. That $1,000 from 2014 would need to be $1,200 in 2024 just to buy the same amount of stuff. Tony only has $1,104. This means his money in that safe savings account was actually losing 1% of its value every single year. Tony was punished for saving his money. In conclusion, inflation is a natural part of our economy. It's driven by demand, by costs, and by government and central bank policies. Since we cannot avoid inflation, understanding how it works is not just an economic lesson. It is a tool for financial survival. You have to stay aware of how your money is growing, because if it is not growing faster than inflation, it is silently being stolen from you. And as promised, inflation is only one side of the coin. The other side, deflation, is just as powerful, and we will cover that in the next video.